Chapter 9. Booms and Bubbles. The stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. Seth Klarman. Behind each stock, there is a business, and these businesses, as a whole, are earning profits each year. So, the stock market has an upward trajectory, and it is evident from its long-term charts. Dow was in the low 100 in 1920, and now it is above 30,000. However, stock prices tend to deviate from this very predictable and smooth upward trajectory. Deviations from a predictable path are a market norm, but sometimes prices diverge to unsustainable levels. Generally, once in a decade, prices either melt up or melt down. As an investor of stocks, you need to identify these rare events. The most common tool that is used by market players is price-to-earnings multiples. In a melt-up, PE multiples expand, and in meltdowns, these multiples contract. Significant market deviations are like day and night. Even a child can tell. It is not a matter of hindsight. Anybody who was an investor in 1999 knew that the market was insane. In March 2009, everybody knew that prices had dropped to unsustainable levels. We all know that melt-ups and meltdowns are both governed by human psychology of getting rich quickly or running to safety. But this is only half the story. There are multiple factors of market melt-up and melt-down. Let's talk about the market melt-up first. Market melt-ups. We have all seen that famous chart of the market bubbles when greed turns into euphoria, and finally, it bursts, and the market comes back to its senses. It repeatedly happened from the famous tulip mania of 1636 to the most recent cryptocurrency bubble. Market melt-ups are closely related to bubbles, but broader and less intense. Bubbles generally happen in one sector of the economy or are confined to one asset class. For example, the dot-com bubble only happened to internet companies, or the mortgage bubble happened within real estate properties. The rest of the asset classes remained very flat or went a bit down. However, in market melt-ups, all asset classes or all economic sectors go well beyond their realistic valuation. It all starts with excess liquidity when too many hands start chasing a few assets. People find it difficult to place their capital and prices start going up. Initially, prices remain closely relevant to fair values and people start realizing small profits by flipping assets. Rising prices establish proof of concept and more people join in. People brag about their realized and paper gains, and it becomes a self-fulfilling prophecy. People feel good, and the cycle continues. Sometime in the middle of the cycle, speculators join in. Momentum crowds come in, and prices soar. It feels so easy to make money. Buy today and sell tomorrow. Don't hold the bag, pass it on. Play the game of hot potato. You've got to dance until the music is on. For sure, contrarians are there. They realize that prices are reaching unsustainable highs. They bet on the reversal of prices but get crushed. This moment in the bubble cycle is called the bear trap. Prices fall a little but quickly start going back up again. There is too much buying pressure for a few short sellers to handle. After massive losses, these bears throw in the towel and buy their position out. Prices leap, and in a couple of sessions, prices rise multiple folds. This phenomenon is called a short squeeze. Now, there is no longer a true seller left in the market. People start flipping more, and prices rise without any check. Towards the end of the boom cycle, the general public starts investing money. People sell their houses and join the game. They invest their life savings into these inflated prices without understanding the underlying nature of the assets, associated risks, and without any prior experience of investing. Suddenly, every radio and TV host starts talking about fantastic investment ideas and invites industry gurus onto their broadcasts. These gurus come with got-rich-quick stories of their clients. Most of these programs are paid transmissions. These are commercials, but the general public does not understand. All they see is the big dollar sign that can be their reality in the near future. Then reality sets in. Prices drop a little, and people think it is an excellent time to buy. At this time, professionals cash out their chips and come out of the market. They know that not much gain is left. However, People who joined late are the ones who buy from them, thinking it is just a small drop and the market will continue its course. Prices go up a little for a week or two. This phase is called the bull trap. People think that the drop is over and the market has started going back again. Then the real fall comes in. The market drops sharply in the blink of an eye. People just freeze, unable to take any action. Within weeks, the market drops so much that selling at these prices makes no sense. It makes no sense for people who bought at the peak, but generally, it is still rational to sell these inflated prices weeks into the fall. It repeatedly happens, more often in pump and dump schemes of penny stocks and less frequently in asset classes like marijuana stocks or cryptocurrency. Even less often, this happens in narrow market segments like the dot-com bubble of the 90s or the Nifty 50 stocks of the 60s. Causes and signs of booms and bubbles. Factors that contribute to a boom are 1. Excess liquidity. 2. A widespread belief that prices can only go up. 3. Complete ignorance of associated risks. 4. Universal ignorance of the relation between price and value. 5. Presence of party culture, gambling mindset. 6. Widespread speculative activities. 7. Mushroom-like growth of financial gurus, advisors, and enablers. 8. People who never invested a penny in their life have started asking for and giving investment advice. 9. Stories of people who got overnight rich become the everyday talk. 10. People started selling their houses and life savings to participate. 11. Cult-like behavior of investors. Any disagreement or prudent advice is considered a threat or an enemy. 12. Fear of missing out, FOMO, takes over cautions and prudence. 13. Mocking of seasoned investors who are sticking to their rules and letting the easy money pass by. If you see these signs, even half of these, run for the hills. Let's start with excess liquidity. Excess liquidity. Liquidity can be defined as the excess to capital, owned or borrowed, that can be quickly converted into an asset class. Overall market liquidity is different from the liquidity of an individual or a company. For example, when you buy a house, you convert your liquidity to an illiquid asset. However, overall market liquidity does not change with this transaction. Now, the seller of the home has access to that liquid fund. Government actions impact overall market liquidity. When the government decides to flush the market with liquidity, it reduces the policy interest rate. A lower interest rate dictates easy access to capital for borrowers and increases borrowers' likelihood of taking advantage of available access. The lower the interest rate, the greater the overall market liquidity. When borrowers feel that they can generate a profit greater than the cost of borrowed capital, they tend to borrow money and invest in assets. It could be a house, a business, stock, or a bond. It doesn't matter whether they generate greater profit or not. Perception or possibility of generating greater profit is enough. Excess liquidity pushes asset prices up, and borrowers can borrow even higher based on their assets' unrealized or realized profits. In previous chapters, we have learned that it does not take enormous amounts of money to inflate asset prices. Remember, the minority dictates prices. It is a loop. Excess liquidity inflates prices, and inflated prices create even higher liquidity. And the circle keeps going on until it does not. When an economy or market is flushed with excess liquidity, people start to invest in unrealistic possibilities. When too much cash chases too little opportunities, money starts to go places where it should never go. People tend to chase prices in all sorts of secured investments. This tendency drives the yield down, and then people start chasing yield in less than desired investments. Overall impacts of excess liquidity are 1. Inflated asset prices. 2. Higher price to earnings ratios. 3. Lower overall yield. 4. People start chasing riskier assets. A widespread belief that the prices can only go up. In a marketplace, perception is more powerful than reality. If the buyers believe that they can sell assets to other buyers at a higher price, then the purchase price becomes irrelevant. If every participant has the same belief, then nothing can stop prices from going up. People tend to weigh more the outcome of an investment than an investment's thought process or decision tree. If I made a good profit in a stock, who cares if buying that share was stupid in the first place? In my early days of investing, I accidentally purchased a share because I mixed up the ticker with a blue chip company that I wanted to buy. 2 days later, the stock that I purchased went up by 10%, and I sold it without realizing my mistake. After a couple of weeks, I realized the happy accident when I was looking at the charts. 2 months later, this company went bankrupt, and the stock went to zero. My outcome was good, but the investment was stupid. In a rising market, everybody makes money. It is easy to make money. Buy today and sell tomorrow, and keep doing it. People tend to weigh their most recent experiences more than the affairs of the past. If they have recently made money, then they extrapolate their recent success to the future. They believe that asset prices will keep going up at the same speed, if not keep accelerating. When enough people believe that prices will keep going up, prices rise sharply, and many people acquire a lot of paper profit. They feel like geniuses, and instead of selling, they keep buying. They sell other investments to increase the stake in one asset that made them paper rich. People forget or ignore the possibility of the market drop. They utter the most dangerous 4 words described by Sir John Templeton. It's different this time. Complete ignorance of associated risk. Risk is high when investors feel risk is low. Howard Marks. Every investment comes with its associated risk. We have talked about the possible dangers and pitfalls of different asset classes in detail in previous chapters. In a rising price environment, people tend to throw analysis of risks out of the window. In their mind, the only possible risk is not to join the party. They ignore the possibility of a sharp drop in prices, let alone consider the financial feasibility of investing in an asset class. Universal ignorance of the relation between price and value. Booms start with some tie-in to reality, some reason which justifies the increase in asset values, and then, and this is the critical feature of speculative mood, the market loses touch with reality. John Kenneth Galbraith. In a boom cycle, people ignore the relationship between price and value. Let's take the dot-com bubble as an example. The internet was indeed a new steam engine or new railroad, an invention that has the potential to change the world, but merely registering a new website is not a viable and investable business. The intrinsic value of an asset is its book value plus the discounted amount of all future earnings. In the case of bonds, the value is easy to calculate. You take all future payments of principal and interest, discount it with a reasonable interest rate, and boom, you have its intrinsic value. In the case of a business or a stock, you need to estimate its future earnings with reasonable accuracy. When you want to calculate the fair value, your starting point should be earnings from the recent past. If a company is still loss-making, you need to look at its revenues and expenses to estimate possible future profits. There were no past earnings in the dot-com companies, and most of these companies were not even making revenues. Those were just registered websites costing their owners a couple of $100s. Most of those companies had no value, but people were willing to pay their life savings to buy those shares. The dot-com bubble was an extreme example when people bought shares of zero intrinsic value. However, in most boom cycles, businesses have some worth, but prices are totally divorced from those values. The most recent example is marijuana stocks. These stocks have some intrinsic value, but prices rose to unrealistic levels. No amount of growth can justify those prices. Even the total legalization of marijuana cannot produce future sales and profits required to justify those prices. On top of that, there is no barrier to entry other than a local government license. If the future earnings are so good, local governments will be more than happy to issue permits to their local companies to keep the profits and taxes in their jurisdiction. Another example is from the late 60s. There was a common belief that a group of blue-chip companies was the ultimate investment. It does not matter what price you pay for these companies because they are too big to fail. There was a nickname for these companies, Nifty 50. It was true that these businesses were unique, but paying the price without any consideration of intrinsic value is always a bad idea. Prices started falling in January 1973, and within a few months, these companies lost 50% of their market value. The oil embargo of October 1973 accelerated the fall, and by October 1974, the broader stock market of the United States was down by 45%. I can quote many examples from the past, but I think I have made the point. In all bubbles and booms, people are willing to pay any price whatsoever without regard to the asset class's intrinsic value. Presence of party culture, gambling mindset. Investment is tedious and boring, an older people's game that you need to play as early as possible in your life. However, in a rising price environment, party culture and a gambling mindset take over. People think it is easy to make money, and it is fun. The stock market is a big giant casino where the odds are in favor of gamblers. The more you play, the more you win. However, the facts are precisely the opposite. It is in human nature to reach for the stars. People are prone to risk small amounts to win big games. That's why millions play the lottery every day, although they know that the odds are not in their favor. It is more likely to be struck by lightning than winning the jackpot in most lotteries. Every casino goer knows that odds favor the house, but millions go to the casinos every night. People like to risk pennies to win dollars. People bring this gambling mindset to the investment world. When the market is rising, these people think they have beaten seasoned experts, and whoever says that investing is hard must be a fool. They count their paper profit every day, every minute, and start throwing parties. They consider themselves geniuses and financial gurus and start delivering lectures on their financial success to every person they know. Sure, they inspire some souls, and these new converts join them in this big, large casino of the capital markets. This party culture was present in almost every boom cycle, but at 2 points in the 20th century, it reached its peak. The first time was in the 20s, especially just before the stock market collapse of 1929, and in the dot-com bubble of the late 90s and early 2000s, just before the bubble burst. Widespread speculative activities. In a booming market, speculators add fuel to the fire. They take large bets on the momentum and open and close positions quickly. Speculators are present in any market, but they are on fire when the market is booming. Options and futures volume go off the charts. Extreme leveraging becomes a norm among the general public, but so-called professional speculators go crazy with leveraging. People who should not be managing their own money start speculating on earning days and IPOs on margin accounts. Mushroom-like growth of financial gurus, advisors, and enablers. This sign of a bubble is rather interesting. It always happens at the very last leg of a bubble. Take any boom cycle as your test case, and you will find a mushroom-like growth of financial gurus who advise you all day long to invest in newly found gold mines. You cannot avoid them. They will be everywhere. You turn on the TV, listen to the radio, or surf the internet. You find these guru advisors almost begging you to take advantage of these opportunities. Investment legends are misquoted or quoted out of context. Words of legendary investors are twisted in favor of these investments, even after these legends publicly deny these conclusions. You will see an unlimited number of businesses recently opened to facilitate investment transactions. Niche market mutual funds and ETFs pop up every day. We have witnessed all of it, most recently in the cryptocurrency boom, marijuana stocks hype, and not too long ago in the dot-com bubble. People who never invested a penny in their life start asking for and giving investment advice. What the wise do in the beginning, fools do in the end. Warren Buffett. In every single boom and bubble, the general public who possesses limited knowledge of asset classes and financial risk starts talking about investment opportunities, new hot stock, gold prices, IPOs, ICOs, you name it. Most of the time, their knowledge is limited to the price action of such investments. They always refer to 2 points in time, and the difference in price between these 2 points. It could be a few weeks or a few months, but generally a short amount of time from a long-term investor perspective. I suffered this in my early days of investing too. In my little circle of friends, we used to talk about stocks and other investments, and I don't remember that we ever talked about the underlying businesses in any serious manner. We used to talk about prices all the time. In a rapidly rising market, the stretch of prices between 2 points of time is amplified. Then so is the general public's behavior towards prices. People think and talk about fantasy investments like they could have invested a couple of months ago and could have been millionaires by now. Some of these people believe that there is still time and a vast portion of gain yet to come, and they should act now. They strongly and forcefully convince their spouses to take advantage of this opportunity before it vanishes away. Sometimes they go behind the back of their partners and invest their life savings. In the majority of cases, people start with small investments. As they experience success, they start raising their stakes, and within no time, the majority of their portfolio is concentrated in a couple of closely related stocks. Prices keep rising as more and more capital is diverted to these amazing opportunities. Stories of people got overnight rich become common talk. At the very last stretch of bubbles, you hear stories of people who bought at the very beginning and made millions of dollars, even billions. You hear those stories wherever you go, at dinner parties, in the office, in the gym. People keep talking about these folks who became millionaires overnight. Just an investment of a couple of thousands took them to the dreamland. It is not true that all of those stories are false. Sure, some people may have made it, but the vast majority of people who invested at the very beginning generally come out when a couple of thousands turned into a couple of 10,000s. It is tough not to sell when you see 1,000% profit. People who manage to stay the course generally keep buying all the way up and keep holding it all the way down. Their paper profit turns into a not-so-good profit right before their eyes. It is not crucial whether some or many people become very rich by investing in a particular asset. The point is, when you hear those stories, it is generally the last leg of the bubble, and the majority of profits have already been made. Take Bitcoin as an example. It started with a few cents, then became $1 per coin. After that, it turned into $10 and then $100. It is already 100 folds from $1 per coin, but you never heard any stories at that time. Those stories became common when Bitcoin ran from $5,000 per coin to $20,000 per coin. It is only 4 folds, and by the time you could react to this, it was already at its peak. Within a couple of months, it dropped to 3,000 or so. At the time of this writing, Bitcoin is again touching 60,000. It may go to 100,000 or even higher, but it never had and will never have any intrinsic value. Paying $100,000 for zero intrinsic value does not make it right. It only makes it even more incorrect. It is a common phenomenon of all bubbles and boom cycles that most of the money is invested at the peak of all bubbles, because only at the top do these stories become everyday talk. People react to those stories, invest a sizable portion of their wealth, and watch it going down in disbelief. People start selling their houses and life savings to participate. Good times cause people to become more optimistic, jettison their caution, and settle for skimpy risk premiums on risky investments. Howard Marks. This behavior of ordinary people is the saddest part of these boom and bust cycles. People start selling their houses at the very peak, withdrawing or investing their retirement money into these bubbles, hoping for the trend to continue for a little while. Prices are easy to understand, and it is easy to isolate or pick assets based on prices. Multiple free stock analysis websites can do it. Understanding the businesses and analyzing the risk is complex. No free website or even paid ones can do it for you. You need to pick up a pen and paper and have a lot of time and patience. Sifting through pages of financial statements and quarterly reports is not easy. People generally don't have a working knowledge of financial statements and don't have time and patience to analyze, so they take the easy route. They pick price action as their primary source of analysis. Analyzing prices is not wrong. However, picking inflated prices as your only source of information is terrible. Even worse is investing a sizable portion of your wealth into these inflated prices at the very peak. but it happens. When people hear others' stories about becoming overnight millionaires, they act upon it and invest their life savings, their houses, and their retirement funds. Cult-like behavior of investors. Any disagreement or prudent advice is considered a threat or an enemy. Investing is not a war or revolution or anything close to this. You are in this business to make an honest profit. There is no need to be a warrior of your investment community. You don't invest to prove a point or to protect an investment ideology. There is only one goal: grow your pile of capital over time. The decision to invest in an asset class must be rational, not emotional. Your decision to invest or not to invest should be based on pure economics. There is no moral obligation to invest. For moral causes, do charity. Do not make investments. If you want to stay away from some investments because of ethical reasons, that's fine. There are thousands of other possibilities. However, in a bubble, people demonstrate some sort of cult-like behavior. They defend their positions, not by economic logic, but by force. They do this by calling those who disagree with them dirty and mocking people who give them prudent advice. Sometimes this behavior is extreme, and sometimes it appears mildly, but it happens in almost all bubbles. Why does this happen? Why would otherwise lovely and gentle people engage in nasty arguments? I think it stems from their belief in that investment. Just because they believe the investment idea in their heart, they go all in. Their investment in that asset class is far beyond any risk tolerance. Their success in life, their future, and the future of their families and dependents rely upon the success of that investment. When your future is dependent upon anything, you want to defend it by any means. Any person who is disagreeing is an enemy. If the investment size keeps you awake at night, you had better cut it down to a more comfortable level. Fear of missing out. FOMO takes over cautions and prudence. When you hear your colleagues' and friends' stories, your neighbor or your cousins making a nice little profit, you feel left out. If your neighbor who does not look or act smart can do it, surely you can too. You think that you are missing out on a huge opportunity. One part of you knows that prices are inflated, but the other part knows that prices were swollen even before and have tripled since. You start learning about the opportunity and come across millions of articles, videos, and TV shows, confirming that it is a once-in-a-lifetime opportunity. Finally, one day you decide to take action to buy a small investment. Prices keep going up and you are proud of your little investment. You brag a little. After seeing a real profit, you decide to increase your investment size. You withdraw capital from other stocks that are dead money for a while and invest a fair amount of capital into this hot new idea. Prices keep going up, and now you feel that you are missing out on your only chance of becoming rich by not investing a considerable amount. You go all in. Every penny that you can afford goes to this hot investment. If this happened to you, you are not alone. Millions of people feel the same way. They invest in bubbles because of the fear of missing out. The fear of missing out is way more powerful than the fear of losing. People ignore all cautions and prudence to avoid the feeling of a missed opportunity. The history of investment is full of examples, from tulip mania to the South Sea bubble, from the roaring 20s to the dot-com bubble, from the Japanese asset bubble to cryptocurrencies. In all these bubbles, people bought assets because they felt it was a once-in-a-lifetime opportunity to turn things around. Investing is not about a once-in-a-lifetime opportunity. It is a lifelong journey of prudent investments that grow with time. You need to start small and let the magic of compounding do its trick. Mocking of prudent investors who are sticking to their rules and letting the easy money pass by. Another sign of an overheated market that touches the boundaries of bubbles is that prudent investors are mocked and ridiculed. People make fun of cautious investors and call them old-fashioned. Newbies challenge the intelligence and market understanding of seasoned investors who have seen multiple ups and downs. One-year graph of oversized profit is compared with decades of consistent, above-average wealth building. Legends are not immune to this crowd mocking. Legendary investors, including Warren Buffett, who stay clear from these bubbles, are mocked, right from the start until the bubbles end. When prices start dropping like a stone, legends are called responsible for the drop. All sorts of conspiracy theories are made without realizing that investing in these bubbles was a mistake in the first place. An investment made with prudence and caution and keeping all of the rules of self-discipline and risk management is a better investment. It's better even if it has ended with a loss. It is better than an investment made in a rush while disregarding any cautions and risk tolerance whatsoever, even if the latter ended up making huge gains. The success of an investment is all about its execution and is not about its outcome. Chapter Takeaways. Excess liquidity is the leading source of all bubbles. When enough people believe that prices will keep rising forever, a bubble starts. In a bubble, people are ready to pay any price without any regard to intrinsic value or any value whatsoever, because they believe they can always sell it for a profit. Bubbles feel like a party. Most of the cash is invested at the very height of the bubble. Fear of missing out is more powerful than fear of losing.